Welcome guys, welcome to another episode of Mutual Funds की बात ICICIdirect के साथ. Today we have Mr. Vetri Subramaniam with us. Vetri Subramaniam is the Chief Investment Officer at UTI AMC. Mr. Vetri Subramaniam has more than 30 years of experience in the market and someone who has seen almost every cycle of the market, right from Harshad Mehta scam to the dot-com bubble to Ketan Parekh to the bull run that we have seen in the early 2000s to subprime crisis and to the recent COVID fall. So it's an absolute pleasure to host you, Mr. Vetri Subramaniam. Just one thing, your career is bigger than my age because I'm a 93 born, so it's an absolute pleasure to host you, sir. Welcome to the show.
Great. Maybe I'll have some stories you may not be familiar with.
Absolutely.
We look forward to that, sir. So you have been doing this for 3 decades, and I think most of it is investing. I was reading, it's the same age as, say, mutual fund industry in India in a structured way. SEBI was formed in 92.
Correct.
And in fact, last 3-4 years have been like a change in trajectory in terms of mutual fund participation. So you have seen so long, and when you look at the last 4 years, like what do you think, what changed, how far we have come? And like, do you believe this is just starting and there's more to come in terms of penetration of equity? So I'll put it this way, many people ask, can equity penetration in India go to 20%? Do you believe that?
So just step back and, you rightly said SEBI started only in the early 90s. I think it's just worthwhile to pause for a moment and remember what exactly was the trading system 30 years ago, right? You made a trade, you did not know till many hours after whether the trade has actually happened or not happened. There was no reference point for you to understand whether the trade actually happened at the price at which it happened. You may not receive delivery of your shares, which is a concept nobody understands anymore, because now when you trade, you expect that you will get a credit in your demat account on T+2. And worse still, you may receive paper shares, which when you send it to the company for transfer, will be sent back to you saying this is bad delivery, meaning some signature is mismatched. So then you have to give it back to the exchange, and it can take another 3 to 6 months for that whole process to get resolved. So what we are seeing today is a market where friction and the pain involved in investing has dramatically reduced. And if I were to point to 2 things which really removed the friction, one was the fact that we moved towards electronic trading, and second is the emergence of demat, which happened somewhere in the early 2000s. Right? These were the 2 things which completely, to my mind, sort of transformed the ability people had in a friction-free and in a painless manner be able to participate in equity markets. Second part of your question was about the scope for penetration.
There's a discussion that, say, despite the progress, there is only 4 or 5% of the population which invest in equity. Like, do you think this number can go to 15%?
See, you have to keep 2-3 things in mind over here, Abhishek. One is, it so happens, I'm doing this interview with you guys at ICICIdirect. You guys started somewhere in about 2000, if I'm not mistaken. The other internet company which started broking at that time was Sharekhan, and I was part of the founding team over there in 2000. So we were sort of in a neck-to-neck race to get the online trading platform going. When we used to do our data crunching at that point of time, we used to look at the shareholding base of Reliance Industries as an estimate of how many retail shareholders are there in India.
Yes.
And the number we used to think about at that time was that there are maybe somewhere between 70 lakh to 1 crore investors in India. Based on looking at Reliance data, there will be some shareholders who don't have shares in Reliance, so it has to be larger, so on and so forth, including looking at what's the size of UTI's investor base, because that was the other big, institution where people held investments. Now, if you take that 1 crore number, just for simplicity's sake, which was part of my business plan in 2000, you fast forward all the way to 2011, 2012, the total number of demat accounts in India was still shown at only 1.8, 1.9 crore. And once you remove the duplication, it was maybe just about 1.2, 1.3 crore. So literally in a 10, 12 year period, there had hardly been any growth, right? Then of course, from 2011, there was a slightly gradual rise. And then from 2018, there is an exponential rise. Right, and today the number that gets quoted is some 12 crore, demat accounts. Of course, a lot of double counting which happens in this. But I think that number is already quite significant. I would just be cautious about extrapolation. One is, whenever you see this sort of a sharp rise, it tends to sort of experience periods where it then sort of, tapers off. We've seen it in the past as well. Second thing to keep in mind is that this can only happen as long as the economy grows and there are people with enough disposable income who then need to make investments.
Yeah.
So you will always find that the base of investors will be constrained by the number of income tax payers. The base of income tax payers in the country is not growing at that rapid a pace.
True.
So I think you will have to hold your horses. Can it happen? Of course it can happen. But don't expect it to happen at the exponential pace that you've seen in the last 5 years.
So there's one more big trend, which is the trend of manufacturing. Like as a country, we were an agrarian economy, and they say we missed the manufacturing leg and jumped into services. But now we are picking up services in a big way via Make in India. So you have seen so many cycles and so many years. Do you think, like, what aspect of Make in India is more exciting as per you and more real? Because along with Make in India, the other part people talk of is China plus one. Now, China is a very complicated country, but there are aspects where we say we can start replicating or replacing some imports. So what is your thought on this theme, and say, is this a theme that you think will keep playing out for many years?
Sure. So I think two things to keep in mind over here, Abhishek. One is, why are people saying China plus one? This is essentially being said by large American companies and most global companies who are saying the political risk of having our supply chain so deeply integrated with China is no longer acceptable to us, and therefore we need to de-risk. When you think about it from that perspective, I think we should remember that there are many countries which are competing with us for this opportunity. And if you look at the data, actually the data suggests that the country who's been most successful is Vietnam in terms of gaining some manufacturing mindshare and supply chain participation from China. Indonesia is active, most of the Southeast Asia is active. And finally, because this is political in nature, keep in mind that actually the US is being equally aggressive about saying we want to bring manufacturing either back to our own borders or to our neighboring countries where we don't have long supply chains in place. So when you look at the nature of the fiscal programs announced by the US government in the last 12 months, whether it is, they call it the Inflation Reduction Act, but it's basically a subsidy scheme to US companies to set up manufacturing in the US. So I think it's not so straightforward to say that the shift out of China will only come to India.
Yes.
There are many other people who are competing with you for this advantage, including the US itself, which is willing to make large handouts. And I was interested to see the other day the news that 2 Indian solar companies are now saying we are going to set up manufacturing in the US because they are actually giving us a massive subsidy for setting it up over there. So I think we just need to understand this context. Having said that, there is one very simple reason why anybody would want to manufacture in India. Not because it's easy to manufacture in India, because there is a large consumer base which can consume that same product in India. And what we've seen in automobiles and certain other product categories, it's always advantageous for a manufacturer to produce in an economy where anyway the local demand is very strong.
Yes.
So I think that will give us some degree of an advantage, but I think we are competing with many countries and we should not, allow this to become our blind spot that, by default, everybody has to come to India. And just one more final point. Too much of the conversations about India manufacturing happen about the context of PLI, right? Let's just look at PLI in perspective. 240,000 crores is the capital subsidy you are giving manufacturers over a 5-year period, right? 240,000 crores roughly is $30 billion. $30 billion you divide by 5 is $6 billion. $6 billion of subsidy in a $3.5 trillion economy doesn't move the needle for the economy. It can move the needle for few companies, but it's a very small number relative to the size of the economy. So I think one of the things that all of us in the financial markets have to get used to is that when you say 10,000 crores, it sounds like a lot, but it is only 1.2 billion in a $3.5 trillion economy. So we have to start thinking percentages over there.
But it's an incremental shift anyway.
Obviously, there is a clear benefit because, as I said, your biggest advantage is the fact that you have a local market. So for any company saying, I want to come to India, not only can I manufacture here, I can also sell into this market, right? How much can you sell into a Vietnam market which has population of, I think, 50-60 million? I mean, there's a limitation over there.
That's as good as one state.
Yeah.
So, since we are at that stage of the market, so we made new highs we kind of like frickled around 20,000 range and we are like hovering around that. But a common question people ask is, itna bad gaya aur badega kya? And you have seen like so long. So my question is, one, is this like how should an investor think of with their money now? And second part of this question I want to ask you is, what are the risks that one should be aware of? Because risk can come from anywhere, and most often risk come from areas that you're not talking of.
Absolutely.
So, but how do you see this?
So, what I just want to say here, Abhishek, because again, as somebody who's been here 30 years longer than he's been on this universe, I should just point out that I think there is a fundamental misunderstanding sometimes people have about equity, right?
Yes.
Actually, when I look at the data, the last 20 years Indian equity market has given Nifty 50. It's a 17% CAGR over the last 20 years. So to those who say the next decade is a golden decade, my answer is, Arre Baba, what about the last 20? That was also pretty golden if it was 17% CAGR. Point number two, if you think there is ever going to be a period of history where the market will only go up and not go down, then I'm sorry you have not understood the equity market, right? The reason the equity market gives you superior returns is that it is accompanied with volatility. So to split your question into two parts, from a price perspective, always remember one thing, and I think this will broadly work even 10 years from now if we meet and have this conversation. Every 1 to 2 years, this market will correct 10 to 15%. Reason you will know later. Every 3 to 4 years, you should expect that it will correct 15 to 25% at least once. Every 10 years, expect that it will correct 30 to 50% at least once. This is the level of volatility you will have to live with in this market. So if your question is, should I buy now? Will the market correct? Answer is, it doesn't matter when you buy. This is the risk of correction that you will experience 1 year, 3 to 5 years, and 10 years. So it is going to happen. The only thing you need to keep in mind as an investor is that, first of all, think not price, think valuation. Right? New highs will keep happening. What you should be concerned about is the new high happening at extreme valuations. I would actually submit that today's high, even though I would say it's starting to get rich in terms of valuations, it is still not as extreme as it was in September 21. And by the way, September 21 today, market has done pretty much nothing over a 2-year period. Yeah. That's because valuations were rich at that point of time. So I think simple answer to most investors would be, you need to practice asset allocation, right? You can't not do asset allocation. Secondly, you will need to rebalance your portfolio. The only way to do these two things is with reference to valuation. And I think that is the only way, along with diversification, for you to protect yourself from market volatility. Because that volatility will happen. It will always come from things you don't know. It could come from, we talked about scams at the beginning. It could have nothing to do with scams. It could just be the business cycle. Yes. It could be the financial cycle. It could be the economic cycle. It can be geopolitics, or it can be a pandemic. We don't know. So it will happen. Volatility will happen. You will just have to deal with it. Diversify, asset allocation, rebalance. I think those are the three mantras. If you practice that with a target that I want to have a good, outcome over my 20-year, 30-year journey to build up a nest egg for myself, you'll do well. If you start playing for, I need to hit a sixer out of the stadium, you will get into trouble.
Got it. So you mentioned, let's pick on from there. So you mentioned allocation, rebalancing. But to rebalance, one needs to have some framework of valuation. And I feel It's a concept that a lot of people struggle with. It's very difficult to really think of valuation when it comes to equity markets. So like, if somebody really wants to rebalance as an individual, can you simplify it to some extent how to think of it?
Very difficult. I mean, all I would say is,
when should I move my income to fixed income from equity? 10%.
So fair enough. So first of all, it's not binary. If you're going to do asset allocation on the principle of 0-100 shifts, it will not work, right? All that we are saying is that, pick your target allocation. It could be 60-40, it could be 50-50. And then you're talking about readjusting the rebalancing in a 10 to 20% range. That's it. Right? So if your target is 50-50, maybe you allow it to become 60-40 or 40-60, and then once again you rebalance. So I think first of all, it's not binary. Too many people who think asset allocation think this means 100% in equity, this means 100% in fixed income. Yeah. I don't think anybody can do that successfully. At least I have not seen anybody do it successfully, and I would not recommend that as the appropriate strategy. So try to find that method in which you'll do it. Again, I would say everybody has their own set of metrics they would want to look at over time. What I've looked at and what we've sort of developed the system, it's been focused on very simple metrics: price to book, price to earnings, dividend yield, and doing a inter asset class comparison, which is the bond yield versus the equity yield. So these are the 4 factors we look at. I would say typically look at 2 to 4 factors. Don't look at more than that. Don't look only at one, because one can sometimes be misleading. So just like a doctor will check 3-4 readings or maybe even 100 readings before giving you a course of action in terms of what you need to do. Look at more than one. Don't rely on only one. That would be my simple sort of logic.
Got it. So I want to quote you on something nice. I found it like very profound but very open, which is like you get a multi-bagger not by your ability to find it, but to hold it. And I think that's the thing that people know. Broadly they know, but the biggest challenge is in practicing it. The stock might go through period when I feel like, boss, it has gone 3x, 2x. Or I might feel, and in current times, news flow are hitting us more often than probably ignorance was a bliss. But now ignorance is not so much of a choice. You keep on getting message about stocks, your holdings on your WhatsApp everywhere, Twitter everywhere, right? So how does one hold a multi-bagger? What is the mindset needed to hold a multi-bagger in current times? Say somebody who invested in 21 is sitting on a stock 3x. What should that person do?
No, so I don't want to answer it in that context
in that
of
frame.
3x or it could be 20x for all I know. So that's not relevant. I think the first thing you have to understand, as I always say, is look at the history. Right? History will show you there are enough stocks which have gone 20x, 30x, 50x, 100x. But the only people who have got the benefit are those who have also lived through the drawdowns. And those drawdowns could have been 50%, 70%, 80%, multiple times through that company's 20, 30, 40 years of existence. I mean, if I look at a company which I sort of consider like a mirror of my career, because Infosys did its IPO in 1993, which is 1 year after I started, you can look at the multi-bagger it has been. But I assure you, you will find more than 5 occasions in the history of that company where it has fallen 50 to 80% from the previous peak. So it is the ability to hold through that which really makes the difference in your ability to get the benefit. And that, I think, has nothing to do with IQ. It has actually got to do with EQ. Right? EQ being emotional quotient. Your ability to go through the drawdown combined with both probability and sheer luck that did you actually hold through the drawdown in the right company. Right? Because in the drawdown, when Infosys came down 80%, 5 other tech companies also came down 80%. They didn't recover. Only Infosys recovered. So it's a combination both of a little bit of luck as well as that foresight that how much of this is a stock market overreaction or are the fundamentals of the business intact. And that, to my mind, is partly science, but partly it's also art. We can't convert it into an algorithm.
I'll chip in here.
Yes.
I've heard you saying this that during 2000 time, during the 2000s, your portfolio went up by 20x or something, and you had seen a 80% drawdown.
It went up 4x and then it dropped 80%.
Yeah, I'm sorry, 4x and went down 80%. And this is what you were talking about. So how did you deal with it? Because I remember you quoted one statement as well that every market fall has a personal story, and you also went through a personal story. So you can just help us out with that.
How do you deal with 80% from the top? I'm imagining.
Yeah, so my realization out of that was very straightforward. Till that point of time, I always thought I can be 100% in equity. I can be 100% in equity. How does it matter? Yeah. But after experiencing that shock where the portfolio went up, 4x, 5x, and then it came down 80%, I said, look, this is like too extreme. Your life situation changes, right? When I believed that I could tolerate 100% equity, I was double income. I was working, my wife was working, I had no kids. And when the damn thing came down 80%, I was working. My wife decided to take a break because I had a baby. So plus I also had to worry about, the baby at home. And I said, okay, now this risk is just more than I can handle. The only reason I could survive that drawdown is that in my case, I had no leverage. And I saw so many people in 2000, 2001 who got wiped out because they had leveraged their positions. And I don't want to get into the nitty-gritty, but if you know how the old Badla system worked, it was effectively allowing you to take leverage on leverage. Right? So as your position went up in price, the mark-to-market profits were actually cash coming to you So you could use that cash to once again pyramid the position. So what starts out as, let's say, 20% equity and 80% leverage, after you do 3-4 cycles, can end up becoming 3-4% equity and 97% leverage. And then when the market takes a 20% tumble, you not only have you have to actually bring 17 rupees of your savings just to, sort of fill up that hole because you borrowed that money. So I think the only thing that saved me at that point of time was I didn't have any leverage, so I could tolerate the drawdown. And we had to make adjustments. So, my wife took a temp job again just to sort of make sure that, okay, we don't feel under pressure. So it's always personal. The only point I will make, and the article that I wrote at that time, as I said, every crisis is both, an opportunity or it can be a challenge.
Absolutely.
For me in 2000, it was a outright disaster. There's no other way to describe it. But in 2009, when the GFC happened, I was on the other side of the table. I wasn't managing money. I was with a company that was about to start a mutual fund. And the collapse of the market actually gave us a brilliant opportunity to start with a clean slate. So every crisis, it's a function of just right place, right time. Is it your opportunity? Or is it something that's going to be a crisis?
The underlying statement here is just don't be over leveraged in the market.
Yeah.
There are people who want to be leveraged. Be leveraged to the point that you can survive that shock which will come later on. That's right.
I would still say don't leverage, but I'll leave that to you to pause. Don't leverage for your investing in the markets. Yeah. You may leverage on your home. That's a separate issue.
At a system level, how do you see the leverage in the market right now? You might have your own frameworks. So what is that telling you? How is the leverage right now in the market? Is there enough leverage?
Honestly, I don't track that too closely anymore. The position is gone up higher, but again, I don't tend to track those numbers too much because from my point of view, it doesn't really add too much value to what we are trying to do in terms of managing money.
So sir, we're talking about leverage. So post-COVID, so post-2020, you've seen a massive shift towards futures and option. And a lot of youngsters have been lured towards that instrument to make 3x, 4x, 10x. And we have seen the data released by SEBI recently that 89% of the investors do not make money, they make losses. And there are hardly any percentage who can beat the FD returns. So what is your take on this? And the ones who are in the early stages of their life, like me who's a 30-year-old, that how should one treat futures and option and how should one treat equity market and to build a wealth over a long period of time of 20 years and 25 years?
I mean, I'm saying this very literally, and with all due respect to those who use the science and math behind options trading. To my mind, options trading is a little bit like buying beyond a point a lottery ticket, right? Whereas when you're buying stocks are not a zero-sum game. Right. You're participating in the income generation by a company which converts into wealth creation in your hand. Right. It's not a zero-sum game. Right? In the equity market, alpha is a zero-sum game, but equity gains are not a zero-sum game.
Yes.
In F&O, and particularly in options, it is actually a zero-sum game. For you to gain, somebody has to lose. And to my mind, that's a bad game to play. Why do you want to play that game? When you have another game which actually allows you to compound money, right, which doesn't have this symmetry of payoff, and you can get an asymmetric payoff on the upside, it's actually like options only. Yeah. Except, it's speed. Not zero-sum.
It's a speed.
Yeah.
It's just the waiting.
But easy money is called easy money because it's easy come, easy go. So, yeah.
So actually someone had told me, and I'm quoting it on this discussion, is if you are directly if you don't have 10 years of understanding of core equity and you're getting overtly into futures and option, you're actually jumping into Formula 1 arena when you have just barely learned basic driving. And the reason when you said zero-sum game and non-zero-sum game, in F&O, who is the counterparty? These are institutions who are sitting on desk and the kind of data that you don't even, first of all, 90% don't even know that data exists.
Yeah.
Leave apart using and leveraging it. That institutions are leveraging with experts who are doing it for 20 years. So you are actually it's entering a casino and playing blackjack on the most experienced table, and just you think your luck is so strong. So that is the most common thing.
I think that's why they say that you have a beginner's luck in the market. Like anybody who starts with an options trading has the good 2-3 trades making profits and ends up losing everything that he has made.
I can vouch for it. So I have always been an investor. There was a phase, and I don't know, something happened in that work from home zone Because you kept on hearing stories of your friends. So I tried and I made it. Beginner's luck did work for me, and for the first 1-2 months, then I did my losses. I realized, boss, and I could also feel the mental strain of it. For me, that was the point to know that everyone has a style. My style is I want to be more peaceful with my money in terms of investing it. So much of stress is not my cup of tea.
No, I think that's very well said. When I started my career, I actually started on the prop book. So it wasn't mutual fund money. And as part of the prop book, we used to also trade positions which could be traded daily or weekly. So certainly we used to trade in and out of positions. And the two things that I figured out quite quickly, even though I would say I managed the prop book reasonably well, it was a good fun experience to trade. It was during the good old Badla days, is that A, it was not scalable, right? Because you can't keep rotating it at that level. B, it wasn't humanly possible to keep doing it beyond a point for the reasons that you also said, that you're not sleeping well at night because you're continuously thinking about how's that position moving, because it's so critical to you in that short time period.
Yes.
So which is why I figured after a point that prop trading for me was not really cutting it, because it wasn't scalable, and B, it didn't let me sleep well at night. And I would say the most important thing about any investment approach and philosophy is that it should allow you to sleep well at night.
Absolutely. And that's what properly investing through mutual funds and responsibly investing. So, sir, suppose somebody who wants to get into mutual fund right now and wants to get into long-term mutual funds. So what are the factors that one should look at in picking up the large cap funds or the small cap funds? Because what happens, we have seen many funds performing previously who are not doing well. For example, the IT thematic fund, which did really well till 2021, but post 2022 we have seen a downside there. So how should one choose the mutual funds who wants to enter right now into the market?
Sure. So I would say that actually for most people, the most preferred portion of your investments in mutual fund, first of all, should go into diversified schemes, right? Now, within that, given the framework that we now have because of the categorization which SEBI has done, you've got this large and mid cap category, you've got the flexi cap category, you've got the multi cap category, you've got the value category. Now, these sort of allow strategies to go across different market caps based on what the fund manager's view might be. To my mind, these funds sit at if you just put this into the context of, let's say, a cake, right? The foundation and what holds that cake together are these schemes. Along with this, you can also have another set of schemes which are very tightly defined by market cap. So large cap, mid cap, small cap. Difference is that here you as an investor will have to take the decision of how much mid, how much small, how much large, right? But all of these two categories of schemes put together can form the base of your cake. Everything else that you do, whether it is a sectoral fund, thematic fund, whatever it might be, is like the icing on the cake, right? And if you only make a cake out of the icing, it will neither be stable nor will it really be able to stand the test of time. So that foundation needs to come from the diversified schemes, either who are a combination of market caps or you select the large, mid, small and you put it together. So that has to be the base of the cake. I think, these ideas of IT did well, those did well. There will obviously be some sector which is doing well, something which is not. I think those need to be more tactical bets. As I said, there's nothing wrong with having some icing on the cake. But remember, it's the icing. Don't mix it up with the core foundations.
Absolutely. So it's better to have a proper flexi, spread out fund.
Yeah, we have almost 7-8 categories which go across the market cap spectrum, or do it yourself, choose the market cap. Those need to be the foundation. These sectoral themes will come and go. And in fact, I would say, again, sometimes people will ask me, I'm doing a SIP in this sector fund. And I will say, why? Because sectors come and go out of fashion. In a sector fund, you need to have a contrarian approach when you go in, and equally contrarian to say, I think the good times are behind this sector now, I need to come out. So sector fund is meant for lump sum investments. I always tell people, don't do SIP in a sector fund. It doesn't make sense.
Right. Because if you are caught on the wrong part of the cycle,
exactly.
you will lose a lot of other opportunity in the market. That's right. So I've been talking about equities a lot, but we spoke about debt as well, because you, from your personal experience, also said that I was 100% equity, but after that you went into debt. So right now, what should be an ideal combination for somebody who wants to diversify his portfolio in terms of equity versus debt?
Sure, yeah. Just to clarify, I didn't go away from equity into debt, but just learned that I needed both in the portfolio. The ratios could vary. Again, problem, Gaurav, is there's no one specific number. I think for each person, those numbers are going to be very, very person specific. So, just like you can't ask a doctor on a TV channel, okay, that guy has fever, he's got cold, cough, shall I give him X medicine or Y medicine? No good doctor would give you a prescription. Neither will I say that, for all investors, this is the right prescription. So I don't want to give a number. I think that's quite pointless. I think the broad thought processes we are familiar with. The younger you are, the more ability you have to take risks. So you can be more exposed towards equity. Yeah. But, over time, you want to also have those buffers in your portfolio, which is what fixed income will give you as you have more responsibilities, as you have more potential forward future liabilities. You want to have some buffer in your portfolio which will kick in, and that's what fixed income can give you.
Absolutely.
Got it. So quickly, I think audience would want this: 2 sectors that you are interested in, maybe one sector that you think is kind of be cautious now or overvalued.
That I'm interested in.
2 sectors which you are interested in.
Well, I mean, I'm very grateful that in the last 2 months at least, the whole healthcare pharmaceutical sector has done well.
Yes.
That's been my contrarian pick at the beginning of this year. It was also my contrarian pick early last year, but finally it has given some life. I still think there are legs to run on that one. I think the companies across, even though the companies are very different from each other, right? It's not a homogeneous sector. Companies are very, very different in terms of the business models. But increasingly what I'm seeing is all the companies are putting their house in order and not giving you too much global gyan. That's normally a good time to, sort of back the sector. So I think that's the area that I still continue to like.
Is it more pharma or healthcare?
I would say it's a combination of both. The only part of the healthcare spectrum which to my mind looks a bit overextended is the hospitals bit. But the rest of it, I see opportunities across the board.
Okay.
The area where I am actually increasingly getting a bit skeptical is the whole capital goods space. I think the valuations have gone through the roof, just looking at forward growth prospects. But we've seen this time and again that you cannot buy capital goods stocks on the basis of order book is up. Right? Actually, the valuation peaks when the order book, starts to crest. So that's an area where I think the valuations are most probably run a little bit ahead of the curve. It's not clear to me that the capex cycle is as powerful as it has been made out to be. It's seen a pickup, but I'm not sure it's so powerful. But more than anything, to me, it's the valuations in cap goods which give me, reason to be a bit concerned that it's gotten overextended.
I wanted to ask about this sector, the IT sector, because that's been the talk of the town recently because of the advent of ChatGPT, the OpenAI, and a lot of management commentary is not giving a proper, there's no straight talks from the management. There has been skepticism and all those stuff. So what is your take on the...
So, what I have learned over 30 years is don't expect management to be able to tell you 1 year or 2 years or 3 years into the future. They will also tell you what they are seeing now.
Yeah.
Right? So, I'm not surprised that right now they are saying times are difficult. But leave that aside for a moment. Cheap valuations in the market will always be accompanied with both commentary and news which is negative. Right? You are never going to get cheap valuations in a stock or at a sector when the company is growing gangbusters and is telling you that the future is unbelievably great. Right? So when you look at IT today, no doubt the commentary is this, adverse. But that's when I want to look at the sector to say, is the valuation now starting to give me comfort? Because I take comfort from valuations, not from what management is telling me. And from that point of view, I would just say that we've seen the IT sector over, now 20 plus years, we've seen how it's tended to behave. There have been cycles and waves of technological changes. Every time they have managed to sort of, catch the next new wave of technology and get a leg up of growth through that. Obviously, the sector today is much bigger than what it was 25 years ago. It can't grow at those rates anymore. But to my mind, IT is a contrarian area in this calendar 2023. I think if I was looking at it, I would look for opportunities to buy into IT rather than stay away from IT. I think the valuation has derated significantly. It's not gone back to what I would call cheap territory, But relative to the peaks we saw in 21, there has been a significant correction. Into more bad news, I would actually look at that as an opportunity to buy. As I said, right, every crisis, you have to decide, is this an opportunity or is this a challenge? To my mind, any more bad news here is actually to be seen as an opportunity.
And
But window is wide for some of the reasons you mentioned. So treat it as a wide window.
absolutely. Again, a follow up to this. You would be focusing on the large cap ITs or the mid cap ITs or any.
So that's a slightly tricky one. And honestly, this is like 20 years of experience. I've always preferred the larger cap companies to the mid-sized ones. I must say that in the last 5 years, what we've seen is some of the mid-sized companies have actually done better in terms of growth, not necessarily in terms of return on invested capital, but in terms of growth. I think that has got to do with the fact that they don't have large legacy businesses which are seeing deflation. Right, so they have more growth-oriented businesses, less legacy. The larger companies have large legacy, so even if their growth business is growing, it's getting compensated by the deflation in the legacy business. So it is giving better growth outcomes, but I would still, on balance, say that my own experience is that as these technological waves keep changing, larger companies in general have navigated the changes better. The mid-sized companies, what happens is that one which plays one wave very well is not able to play the next technological wave change as well. So that's my advice.
In a safer territory going here, the large cap companies would look
Got it. Sir, are you into reading outside markets? Any book recommendation or any movie, any documentary, anything you've seen, any series?
I love reading very, very widely, and I would recommend anybody who wants to invest, please do not restrict your reading to the markets. You're wasting your life, you're wasting your mind by only reading about markets.
So a few recommendations outside the market which help.
Well, not which help, but just which help you understand the nature of the world. One of the books that I really enjoyed reading, and I must admit it took me 1 year to get through the whole book because it was a massive book, is a book called Guns, Germs and Steel by Jared Diamond. And it's actually an attempt to try and understand why cycles of development have been different for communities and geographies, right? But it was very, sort of mind-opening to read that, to understand, because it's nothing connected with economics. It's actually connected with history and
Anthropology,
biology, anthropology, and all of those things. But it gives you the sense of what are the initial factors and what are the catalysts which cause change, rather than looking at history backward, where we only see an outcome and we look at the actors which cause that outcome to happen, right? I find reading a lot of this history actually very, very interesting. But it's a combination.
It's a very dense book.
I can't read only market books or only, history or even fiction. The only thing I would say is, in recent years, my reading of fiction has come down. My reading of autobiographies has gone up, because I now find the real life stories of individuals more interesting than the pure fiction. So it's a combination of all of these. But I mentioned Guns. So the best autobiography I've read in recent times is Shoe Dog, which is Nike, Phil Knight. That was the best, I think, in recent times as an autobiography. On investing, I think the two best books recently I've seen, one is of course Psychology of Money, which most people know. The other one is Investing, the Last Liberal Art by Robert Hagstrom. And a very interesting book that I think, particularly if you're Indian and you want to understand the very sort of interesting bit of our history, East India Company, the Opium Wars, is a book called Opium Inc.
Opium Inc.
Okay. But it's a fascinating story, and even people in Bombay should read, because that's when you realize that this whole city is literally an outcome of the city. We all think about cotton, but actually the initial boom in Bombay was driven by the opium trade.
Yes.
Then came cotton. All the businessmen who earned their money in opium got respectability by shifting to cotton. So it's an amazing book. Just sort of opens your mind in terms of history.
Interesting. So we got 4 or 5 book recommendations. What are you going to take the last?
I'll just ask. These are the books. So what do you do when you're not apart from reading and not looking in the market? So what do you do? What are your hobbies, or what do you like doing?
I'm just looking for ways to sort of de-stress. So I enjoy reading for sure. Love listening to music. But the thing about music, as they say, is you get locked into the music that you heard in your 20s to early 30s.
Right.
So in music, you very rarely discover new music once you go past your mid 30s. What you heard in your 20 to 35 becomes your lifelong choice of music. But I still enjoy that bit. Thankfully, I've been privileged enough to have a small farm which is not too far from Bombay. So going there is always a break from noise, pollution, greenery. So that again gives me a way to take a break from the hustle and bustle of the markets. Yeah, and I love my daily, not daily, but sort of at least 3 days a week, play some badminton. So that keeps me, occupied. I think sport is a good thing.
Absolutely.
Playing sport is not just exercise, but also keeps you pretty sharp in terms of,
Absolutely.
thinking about it. So I love that thing of playing sport. Badminton has been my chosen opium, so I love playing badminton.
So,
Got it.
thank you, viewers. That was Mr. Vetri Subramaniam from UTI AMC. If you like a video, please hit the like and subscribe button. Also, you can look at the offerings from UTI on their website and also on the ICICI Direct website. We have a feature called One Click Basket where you can may choose funds based on your own dream, like what returns you want or why are you investing in the funds. So you can do check that feature as well. So thank you so much for this part. See you in the next one.
Thank you.
Please note, mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.